Hello everyone, hope you're doing alright. Today I wanted to quickly talk about high resistance liquidity runs and low resistance liquidity runs. So as always, I'll try to simplify it as much as I can and put it into simple steps for you to learn and apply yourself. So as you can see here, to identify a low resistance liquidity run, we gotta have a higher time frame bias, higher time frame narrative. So higher time frame has got to support our ID. Then the next thing would be intermarket analysis, aka correlating assets supporting the ID as well. So if we're looking at the S&P 500 or E-mini S&P right here, then I want the bonds to agree with my ID and I want the dollar to agree with my ID as well. Then the last thing is the pattern. The pattern should somewhat agree, but I think the pattern is of the least significance, because if the higher time frame agrees and intermarket analysis agrees, then price is going to do whatever it wants, no matter what the pattern is on the lower time frame. So let's dive right into it. We can see we swept this high right here on the daily time frame, came into this SIBI right here, then market structure shift, market structure gets confirmed right here. So the higher time frame is agreeing on this possible draw on liquidity. Then the next thing is an intermarket analysis. So does the bonds and the dollar agree with this idea of going lower? So here we are on the treasury bond, the 30-year treasury bond. And if we take a look at the weekly, we have this weekly SIBI we came into. Then on the daily, we have our market structure shift lower. We are clearly pushing lower as well. So this is agreeing with E-mini S&P currently. Then the draw on liquidity can be the same as on E-mini S&P and this low. Then let's take a look at the dollar next. All right, here we are on the dollar. The dollar is inversely correlated to the E-mini S&P and the bonds. So if the dollar is moving higher, bonds should be moving lower, and E-mini S&P should be moving lower as well, and vice versa. So if E-mini S&P is moving higher, the bonds are moving higher, dollar should be going lower ideally. Then if we take a look at the weekly right here, we have this order block right here that we just came into. Then the daily is pushing away from it. It's rejecting the order block, moving higher, market structure shift, market structure gets confirmed. So we can say the higher time frame agrees on every correlating asset, and intermarket analysis agree with our ID as well. So now we have a higher time frame checked off and intermarket analysis checked off. Now the last thing for us to do is trade into the direction of the higher time frame and start looking for a pattern of low resistance liquidity runs. So again, a higher time frame agrees, intermarket analysis agrees. Now we need the pattern. So the pattern, ideally we want to see some engineered liquidity, like a trend line liquidity here, that can be easily ran out. And a low resistance liquidity run is defined by the time it takes to take it out. So a low resistance liquidity run will usually have big candles and price is not hesitating and not taking its time to take it out. It's doing it with speed and force behind it. Now to get the force and speed behind it, we need to have the higher time frame agree with our ID. Ideally, you also want the monthly to agree. If the monthly agrees, then everything on the daily and the weekly will likely be a low resistance liquidity run, because institutional trading is mainly done off of the higher time frame, meaning 4-hour, daily, weekly, monthly, and the higher the time frame, the better the low resistance liquidity run will be. If you want to target low resistance liquidity runs and want to trade them, follow these simple steps. Make sure first of all that the higher time frame agrees with your ID. Then intermarket analysis should also agree with your ID, and then start looking for a pattern. The pattern is the least important, because if you have all of these already agreeing with your ID, then the pattern will not hold. Ask yourself, if institutional trading is done on a higher time frame, then how does a 15-minute pattern hold any significance? So that's why the higher time frame is so important to identify high resistance liquidity runs and low resistance liquidity runs. Now, high resistance liquidity runs will be against your high time frame bias, and intermarket analysis will likely not support the ID, or markets will be decoupled, meaning they are not moving in sync. If the dollar is moving higher, E-mini S&P is maybe also moving higher, that indicates a high resistance liquidity run. Then as you can see, everything on the downside here is a low resistance liquidity run. Price has no issue taking out the lows right here. Price is moving with speed, it's doing it fast, it's forcing its way down with ease. Then for the entries, it becomes easy once you know this, because all you have to do is identify your premium array, your lower time frame confirmation, target the lows. And that's basically it. I hope you found this insightful. I hope I helped someone. Just follow these simple steps to identify your low resistance liquidity run. If they don't agree, then it might be better to adjust your risk, or even just stay out and wait for a low resistance liquidity run again. Let me know if you found this insightful, if you like the simple steps of identifying a low resistance liquidity run. And I'll see you at the next one. Thank you.